welcome to the 75th episode of Prime Property, your weekly real estate reckoner. I'm Nayanthara Rai, and this is what we planned for you on this very special episode. RBI Governor Raghuram Rajan has played along, doing his bit to further the Narendra Modi government's vision of housing for all. We tell you what the central bank has done to redefine affordable housing. The centre also pitching in to make affordable housing more popular. In an attempt to attract FDI, the government will exempt projects from the minimum built-up area and capitalisation norms if 30% of the project cost is earmarked for low-cost housing. Selling a house? Tax changes you need to know in our tip of the week. We tell you how the budget has changed the rules for property buyers and sellers. From a 50,000 rupee higher tax rebate for home loans to real estate investment trust to 7,000 crore rupees for 100 smart cities to 4,000 crore rupees for the national housing banks to extend cheaper credit for affordable housing, Arun Jaitley's maiden budget on July 10th attempted to build new blocks for the battered real estate sector. And the Reserve Bank is playing ball. Within a week of the Union Budget, the central bank agreed to a long-standing industry demand by awarding infrastructure status to affordable housing. It's also allowed banks to raise long-term bonds to provide cheaper debt to this segment of real estate. But what is of utmost importance is the Reserve Bank's definition of affordable housing. Don't imagine these to be small dwelling units. Along the lines of the definition accorded to affordable housing in the Income Tax Act, that's just 250 to 850 square feet. Neither has the RBI defined affordable housing with a price tag so cheap that the entire concept is alienated from market realities. Instead, the central bank has given a more practical definition. Houses costing up to 65 lakh rupees with home loans of 50 lakhs in the 6 big metros, and houses in the rest of India costing up to 50 lakh rupees with home loans of 40 lakh rupees. Manasi Gilani finds out what the RBI's latest move means for home buyers.
RBI Governor Raghuram Rajan has played along doing his bit to further the Modi government's vision of housing for all. In a stimulus for affordable housing, RBI not only eased financing norms, but also provided infrastructure status to the affordable housing segment. Banks will now be allowed to raise long-term funding for affordable housing projects, thereby opening up financing options for cash-strapped sector. The grant of infrastructure status not just gives them access to funds for construction of affordable housing projects, but will not alleviate the sector from its problems surrounding increased land costs and delays in approvals.
There's a huge gap between the demand and supply of funds in the housing finance sector. To that extent, yes, it's a welcome step. The banks will also lend to the housing sector, especially, inclusion of at least the definition of affordable housing has now come for the first time.
RBI says banks can now provide loans from proceeds of long-term bonds issued of 7-year maturity, and money raised through long-term bonds will be exempted from cash reserve ratio and statutory liquidity ratio requirements. This means that banks will now be able to commit to the entire corpus of funds raised through the issue of these bonds.
It at long last allows us to match the loan with the productive life of the asset, instead of having to scrunch the repayment in a much smaller space of time.
Also, currently the housing loans up to 25 lakh in metros and 15 lakh in non-metros are considered as affordable housing loans. But going forward, definition of affordable housing loans have been relaxed, and loans up to 50 lakhs to be given to individuals for houses costing up to 65 lakhs located in 6 metropolitan cities, that's Mumbai, New Delhi, Chennai, Kolkata, Bengaluru and Hyderabad. And for non-metros, loans up to 40 lakhs for houses costing up to 50 lakhs will be classified as affordable housing loans. While the BJP manifesto also sought extension of interest subvention of at least 3% for 5 years for dwelling units of less than 80 square meters, Finance Minister Arun Jaitley is yet to relent to that demand. And bankers feel that may not fructify at all. But as a positive, RBI has assured that it will periodically review the definition of affordable housing on account of inflation. Developers have begun resizing and redesigning their products upwards of 60 lakhs in order to claim cheaper funding. But those in metros, where apartments are not less than a crore, are not enthused. Developers argue that project financing is the second biggest cost, and this may ease after the latest measures. But with no relief on home loan rates, the question is whether these incentives are enough.
Most banks are giving housing loans at an interest rate which is equivalent or marginally higher than the base rate. So therefore, the only way a bank can give money at much lower rates is to lower the base rate. If they lower the base rate, then the entire assets of the bank get repriced downwards, which makes it impractical.
So will affordable housing be really affordable for common man?
Housing finance companies are already working on a wafer-thin margins, which are not too much for them to actually shell it out. But yes, we may see some opportunistic companies coming out and rolling out offers, which will be very, very minutely differential in terms of what they can borrow. That may not really make huge impact or major impact or a small impact for a consumer who is looking at a relief at this point of time.
And though some measures have been initiated by the government to ease the burden on real estate sector, the industry now looks forward to the revival in demand. In Mumbai, Manasvi Gilani.
The impetus to affordable housing does not end here. A substantially simplified FDI regime is the second booster shot from the finance minister. It wasn't part of Jaitley's budget speech, but Team Prime Property spotted it in the budget fine print and tucked away in a longish press release dated 16 July of the Commerce Ministry on FDI caps. The government says projects which commit at least 30% of the total cost for low-cost affordable housing will be exempted from the minimum built-up area and capitalization requirements for FDI, with the condition of a 3-year lock-in. It's clear the government is hoping this is a big enough incentive for developers to earmark a large size of their projects for affordable housing. Experts say this move will pay off, especially in smaller cities where land is cheaper and builders have elbow room to protect margins and actually build low-cost houses. This is over and above what Arun Jaitley had announced in the budget. That's the relaxation of eligibility norms for FDI in construction. The budget had reduced the requirement of the built-up area from 50,000 square meters to 20,000 square meters and halved the capitalization norm from $10 million to $5 million, but with a 3-year lock-in post-completion.
This will encourage more people to invest in India. The risk will be lower because it's a lower development area. The capitalization is also less. Also, this will encourage people to invest in Tier 2 and Tier 3 cities, because when you had a restriction of 50,000 square meters, a lot of the Tier 2, Tier 3 cities and towns could not absorb such a large project. So with this going down, I would see that more money would go into Tier 2, Tier 3 towns, will encourage more people to invest. I do not expect huge amount of funding coming in overnight.
The announcement of real estate investment trusts or REITs in the budget has enthused developers and has been hailed as a game changer for the cash-starved sector. Think of REITs as listed units of a mutual fund, where the underlying ownership is in a commercial or rent-yielding retail property. Developers started unveiling plans for REITs within days of Arun Jaitley announcing a tax pass-through status. And in spite of tax experts saying an exemption from dividend distribution tax and corporate tax is necessary to ensure the successful launch of REITs. Manasvi Gilani reports that industry players are not wasting any time in getting the ball rolling.
$10 billion is set to flow in India's real estate sector. And it's all because Finance Minister Arun Jaitley took the long-awaited step of allowing pass-through status on taxation to REITs. What this means is that the income generated would be taxed in the hands of the investor and the fund would not have to pay any tax on the same. And real estate participants are falling over each other to get in line.
The Embassy Office Parks portfolio at the moment is about 16 million square feet with development potential that brings it up to about 26 million square feet. It's well known in the market that one of our shareholders, Blackstone, is out there on an acquisition mode and looking at other assets, so it's quite possible that the numbers that have been bandied around, about 40 million square feet, could come to pass. In terms of valuation, again, that depends on the scale of the portfolio, but for sure it would be in the order of $2 billion. Sometime early in 2015 is a reasonable time frame.
We currently crossed 10 million square feet of as a leased portfolio, and we're also looking at expanding the portfolio to something like a 23 million square feet of leased portfolio before we actually list. This will come through mostly through acquisition and partly through whatever is being developed under our brand.
Clearly, I think the REIT would open up a completely new set of equity instruments hopefully revive the FII interest in the Indian equity market, get a lot of HNIs into the equity investment market on the real estate front. People who necessarily can't own an office building all by themselves, but through the holding of a unit in the REIT, get to share in both the rental income as well as the potential upsides. So I think in that sense, REIT is clearly a very important step, in creating a new capital instrument for the real estate sector.
The list is long and has some heavy hitters in the mix. From developers like DLF, K. Raheja Corp, Prestige Estate, Panjsheel Realty and Phoenix Mills, to private equity players like Xander, Kotak Realty Fund, Red Fort Capital and Golden State Capital. Experts say the list of beneficiaries stand at over 18 and is growing by the hour. So the cash-strapped real estate sector may soon be putting troubled times behind it.
Given our portfolio of rental assets, REITs, once all these residual issues are clarified, do present a pretty credible option for any player with the major base of rental assets.
In terms of the kind of money that the REITs can raise, I would peg it at, say, $4 to $5 billion in the next 12 to 18 months, which means 25 to 30,000 crores. That's the kind of money that REITs should be able to raise in the next 4 to 5 months.
Today in India we have about 345 million square feet of completed office stock which is leased. Out of that, 100 million square feet can be REITed straight away. The balance 90 million square feet will take a little bit of time to REIT it out, but 100 million square feet is straight REITable, which in itself is between $10 to $12 billion value. So in effect, you can raise between 60,000 crores to 72,000 crores.
But REITs can also be done by corporates as well as government enterprises. So public sector enterprises, public sector banks, corporates like IT companies or any corporate. Any of these entities which have a large commercial real estate portfolio can go for a REIT.
REITs are a new investment opportunity for retail investors to participate in the property market and the capital markets. So what all should you keep in mind if you do choose to invest in them?
So really, who are the promoters? What is their track record? How financially sound they are, and what kind of assets they're going to put money in which cities, which asset class would be what the individual should look at.
The FDI guidelines obviously are very important because it does provide access, especially to the mid-range developers to funds. So the relaxation in the FDI guidelines is welcome. Also, from whatever one has read from the speech, I think the linkage of FDI to actually the physical asset creation and the post-completion lock-in is also a welcome a welcome step, because that clearly shows that he wants the FDI to not only come but to also come and create the physical assets on the ground.
If you have a REIT manager who has people who've had experience in the real estate sector, and it also has people who have had experience in the financial services sector, then one would expect that REIT manager to be really effective.
This amount could very well get a lot bigger, a lot faster. And even as realty firms make a beeline for real estate investment trusts, tax experts say the finance minister may reconsider the levy of distribution tax and corporate tax.
The ask of pass-through was that the special purpose vehicles in which the assets are would pay taxation but would not be liable to dividend distribution tax. Now that dividend distribution tax has not been exempted. So therefore, you will have a 42% charge before the income goes to the unit holder. If there are SPVs which have got sufficient debt in them, then the debt can be extracted to the REIT and onwards to foreign shareholders at a 5% withholding and to residents at a 10%
So good enough
withholding.
to attract capital?
That's good. So on a case-by-case basis, depending on how much debt there is in the SPV, you may have a good structure. Otherwise, it's not a full pass-through.
Sources in the finance ministry, though, say that there will be no exemption from dividend distribution tax and point out that despite being treated at par with equities, REITs have been exempted from securities transaction tax or STT. In Mumbai, Manasvi Gilani.
On the back of so many reforms coming in for the property market over the last 10 days, we saw major up moves this week on the Realty Index. The BSE Realty Index gained 4%, outperforming both the Nifty and the Sensex. And on that note, we're going to slip into a short break. On the other side, we'll tell you how the union budget impacts the tax saving of home buyers and home sellers. Stay tuned.